So now you had these institutions that are now lending money to the United States government. And why does that matter? Because the United States government's interest payments that they have to pay don't just depend on how much debt that they have, but it depends on the interest rate on that debt. So now when interest rates go down, the value of the debt is not as much because you're paying that debt back with a lower interest rate. So what that ultimately meant is that the United States government got to borrow this money for essentially free because they had these super low interest rates. And these super low interest rates were lower than the inflation rate. So the government is borrowing this money for essentially free. They get to invest it into the economy by spending more money. And as they spend more money, they're working to grow the economy because the government is borrowing money for essentially free. Then they work to grow the economy, and they were able to grow the economy faster than the national debt. But somebody had to pay the price, because that meant that the people that lent money to the United States government, that were essentially forced to do so, had to lose money.